Welcome back to the Commodities Institute podcast. I'm Emily Costa, and today is November 25th, 2025. As always, thank you for joining me for a deep dive into the forces shaping global resources, energy, and trade. And today, we have a rich mix of stories to unpack across oil, metals, agriculture, and the freight markets. I want to start in a part of the metals world that has been simmering with tension for nearly 2 years. Because after a long standoff, a major breakthrough has emerged in West Africa, where Barrick Mining and the government of Mali have finally reached a sweeping deal to end their dispute over the Loulo-Gounkoto gold complex. This is one of the most important assets in Barrick's portfolio, a mine that once generated nearly $900 million in revenue in a single year, and yet it had been caught in a political storm as Mali sought to enforce its newer, more demanding mining code. Now, according to the newly reached agreement, Barrick will drop its arbitration case. Mali will end all charges against the company and its affiliates, and most notably, 4 jailed employees are being released, with full operational control returning to Barrick. Even more significant, the company will receive a 10-year extension on its mine permit. In exchange, Barrick has agreed to sign Mali's 2023 mining code. This is a moment of relief for investors. Barrick shares surged to an all-time high of $55.93. But there is also a strong undercurrent of uncertainty. Analysts are openly questioning whether Barrick will ultimately choose to stay in Mali. The regulatory environment remains fragile, and after the government seized 3 metric tons of gold earlier this year, trust is thin. For now, operations are expected to restart by January 1st, but the long-term relationship between miner and state still feels complicated, and that's something we'll continue to monitor closely. From metals, let's shift to agriculture, where there are suddenly signs of acceleration after a long period of hesitation in Chinese grain buying. The US Department of Agriculture says a long-anticipated aid package for American farmers is likely to be announced within the next 2 weeks. But what really has markets leaning forward today is the fresh momentum in Chinese purchases of US soybeans. After months of avoiding American supply, China bought nearly 1.6 million metric tons of soybeans in just 3 days, its strongest buying pace in 2 years. 2 cargo vessels are already en route to Louisiana to load soybeans, marking China's first shipment from the US Gulf since May. And a 3rd vessel is preparing to load sorghum in Texas for the first China-bound shipment since mid-March. All of this comes after an October meeting between President Trump and President Xi, where Washington claimed Beijing agreed to buy 12 million metric tons of US soybeans by year-end. China has not confirmed the full scope of the deal, and Agriculture Secretary Brooke Rollins put it bluntly, we've got a significant way to go, but the shipments themselves suggest the logjam is finally breaking. Welcome relief for American farmers facing lower prices, higher input costs, and record crop volumes this season. Speaking of record crops, the winter wheat story is also evolving. The new crop is 97% seeded, conditions have ticked up to 48%, good to excellent, and recent rains across the plains are helping. Nearly 1/4 of the crop remains too dry, but the trend is upward. Meanwhile, the corn harvest, on track to be the largest in US history, is 96% complete, and soybean harvesting has essentially wrapped up. So the US enters winter with bins overflowing, and global buyers are watching closely to see how the US-China dynamic continues to unfold. Let's turn now to rare earths, an area that tends to operate below the headlines but underpins the modern industrial economy. Lynas Rare Earths, the largest producer outside of China, has warned that it will suffer a 1-month production shortfall this quarter. The reason? A spike in power disruptions at its Kalgoorlie facility in Western Australia. These outages have already taken a meaningful bite out of mixed rare earth carbonate output, which is then shipped to Malaysia for processing. The timing couldn't be worse for countries seeking to diversify their supply chains away from China. Lynas is working with regional power authorities to stabilise supply, but even in the best-case scenario, improvements won't arrive in time to salvage this quarter. Analysts have already cut their expectations by nearly a full kiloton of neodymium praseodymium production. This is one of the most crucial materials for high-performance magnets used in electric vehicles and wind turbines. Prices have been under pressure, but disruptions like these remind buyers just how concentrated and fragile the supply chain is. Now let's move to oil, but instead of starting in Nigeria or the Middle East, as we often do, I want to take you first to Beijing, where Russia's Deputy Prime Minister Alexander Novak has confirmed that Moscow and Beijing are discussing ways to expand Russian oil exports to China. This is part of a strategic alignment that has only deepened since Russia's campaign in Ukraine began in early 2022. China currently buys roughly 1.4 million barrels per day of Russian oil by sea and another 900,000 by pipeline. But the new discussions include extending supply agreements through Kazakhstan for an additional 10 years, all the way to 2033. This comes at a sensitive moment. The United States recently imposed sanctions on Rosneft and Lukoil, Russia's two largest oil producers. President Putin has brushed off these penalties as unfriendly but economically insignificant. And so far, Russia's crude exports have remained remarkably steady. China and India continue to serve as Moscow's pressure release valves, absorbing supply that would have otherwise flowed to Europe. But not all of Russia's energy exports are escaping scrutiny. Several US senators are now accusing the Trump administration of lax enforcement on sanctions tied to Russia's Arctic LNG 2 project. Novatek, the operator, has reportedly shipped about 14 cargoes of liquefied natural gas since August, with Chinese buyers receiving discounts as steep as 40%. Critics say this undermines efforts to cut off financial support for Moscow's war effort. The administration has responded by saying additional sanctions remain under review, but many in Washington argue that existing loopholes must be closed. Now let's pivot to a different kind of oil story, one full of ambition, capital commitment, and industrial transformation. Nigeria's Dangote refinery has struck a landmark agreement with Honeywell as it pushes forward with its enormous expansion plan. Dangote wants to double capacity to 1.4 million barrels per day by 2028, making it the largest refinery on the planet. Honeywell will supply catalysts, technology, and equipment that will allow the plant to process a wider range of crude grades. This refinery has already cost $20 billion, and it remains Africa's largest industrial project. For decades, Nigeria has exported crude but imported nearly all its refined fuels, a paradox that drained foreign exchange and invited repeated shortages. Dangote's long-term vision is to end that cycle completely. If the expansion is achieved, the refinery could process nearly all of Nigeria's current crude output. And there's more. Dangote also intends to increase polypropylene production to 2.4 million metric tons per year by licensing Honeywell's Oleflex technology. This is a massive step into petrochemicals and plastics, areas of strong demand growth across developing markets. Finally, let's close in the freight market, where today's focus returns to the US Gulf Coast. 3 vessels are now en route to load soybeans and sorghum bound for China, signaling what may become a larger pattern as Beijing resumes purchases. The vessels are headed for terminals owned by Cargill, Zenno Grain, and Archer Daniels Midland. Traders have been waiting months for these loadings to materialize, and their arrival injects some optimism into what has been a year defined by uncertainty. Before we wrap up, one more grain headline worth noting. Saudi Arabia has purchased 300,000 metric tons of wheat for delivery early next year. Traders believe much of the supply will come from the Black Sea region, possibly Russia or Romania, though competitively priced Argentine wheat might also enter the mix. It has been an intense day across oil, metals, agriculture and freight, each market moving for its own reasons, but all interconnected through the global web of supply, demand, politics and logistics. Thank you for listening to the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share and leave a review. I'm Emily Costa, and I'll see you tomorrow.